TFNN.
All right, welcome everybody to today's Option Hour. My name is Don Kaufman. I'll be the host of the Option Hour, here to really answer any of your options-related questions. But, of course, you can call up. You can talk about futures. We can talk about options. We can talk about options on futures. We can talk about stocks. We can definitely today talk about earnings. And as you guys know, we are in full swing here for earnings, and that's kind of what's on the menu here for today is earnings. And if you've got questions, you want to talk a little bit about building some trades around earnings, by all means, give us a call, 877-927-6648. So, of course, today we've got Apple after hours, and I think everybody's been taking a look at that. In fact, I was just looking to see if there's any news out prior to the earnings coming out here. Nothing really big brewing on Apple right now. I wouldn't be surprised, though. Apple should hover right around where it is right now, right around that 375 strike. Should be typically drawn to a strike before an earnings announcement. But again, what we're really going to talk about today is, well, first we'll answer any of your option-related questions. Again, options, futures, stock, give us a call, fire them away. But also, if you've got specific questions and or comments surrounding an earnings announcement, or you want to talk about building a trade around earnings, give us a call. Again, 877-927-6648. As usual on this show, we can really talk about anything options related. Nothing is out of scope or out of bounds. We've had everybody call in here from somebody that wanted to talk about a call or what a put is, all the way to somebody that wanted to learn a little bit more about gamma scalping. So we've pretty much heard it all. I am coming to you today live from downtown Chicago. Stuck in a couple of meetings here in Chicago. As a lot of you guys know that listen from time to time, I'm actually based out of Scottsdale, Arizona. And I can definitively say that the weather in Chicago, it sucks even during the summer. Maybe not as bad as 110 that it is in Scottsdale, but it's like 90-something degrees here with about 90% humidity. It's pretty horrific out there. Anyway, with that, let's talk a little bit about options here, give you guys a quick rundown of the markets. But what you guys need to do is give us a call, because this is a call-in show, and it gets a little lonely halfway through a call-in show if nobody calls in. So, of course, the number to give us a call at is 877-927-6648. With that, quick rundown of the marketplace here. S&P 500 futures up 11.75. NASDAQ futures up 39. Just off the highs of the day, we've seen, obviously, the NASDAQ bursting to the upside here. Entire market's been relatively strong here today, right out of the gate. Other things to look at, Dow's up 121. The VIX down about 92 cents, which is kind of surprising for the rally that we've seen. The VIX is only off about 92 cents, so for the most part we're rallying right now, but we're definitely still guarded a little bit. Oil's $1.78 today. Bonds have actually been bouncing around quite a bit, and of course these bonds are ultimately, a lot of that is dependent upon, is the federal government and Congress going to get together on a plan and raise the debt ceiling? It is going to happen in one way or the other. They're not going to let the entire world fall apart here overnight. But bond markets here are still, and by the way, bond markets, they're totally pricing in the fact that, nothing is going to happen, which is interesting. So bonds are literally pricing in that the debt ceiling is going to be raised, that the world is going to be just fine. Basically, the bonds, what I'm telling you, are pricing in lower interest rates right now, and there's almost no fear priced into that bond market. If there was fear priced into this bond market, you would actually see this /ZB and the /ZN. The ZB, the /ZB, is, of course, the 30-year bond futures. The ZN is the 10-year note futures. You'd see those sell off pretty markedly if there was a lot of fear out there. So you'd actually see, of course, the bonds selling off is inverse to the interest rates. As the bonds would sell off, interest rates, of course, would appreciate to the upside. Now, if you're in a position, like I've talked about the last couple of weeks, many of us are what's called long TBT. Now, long TBT means we are effectively short bonds. So for long TBT, we're effectively long interest rates and sitting with that particular trade. Because if you look at the future, okay, interest rates right now, they're not, short-term interest rates literally are sitting at zero. Interest rates, though, they don't have very much room to go to the downside. Sooner or later, interest rates do appreciate, so it's an interesting trade, of course, to think about, is being long something like TBT. And by the way, whenever I, hop on a show like this, here at TFNN or any of the things you guys have ever heard me do, of course, on the ThinkorSwim platform, whenever I'm out here and I'm saying I'm long this or I'm long that, okay, doesn't necessarily mean I'm like long shares. All right, so I want to make that very, very clear. Because I say I'm long, I don't like the idea of owning TBT shares all that much because it's double inverse, and those are depreciating shares, meaning the shares themselves have a decay factor associated with them. Anyway, keep that always in mind as we go along, and we'll talk a little bit about some of these underlyings. But with that, I'm going to jump to a couple of callers here, and of course, you guys can give us a call. It's 877-927-6648. I'm going to jump to Jim in Palm Harbor. We've talked many times. Jim, are you there?
Hi, how's it going, Don?
Good, good. How you doing this week?
Pretty good. I've been watching IWM just trade in the range, and we can't get over that 0.786, and we sell off. And so what I've been doing is I've been selling like puts on the weeklies. And this morning I sold the 34s for 90. It's trading like at 73. I did it 10 times, and I guess what I'm trying to figure out, and I usually close these out at the end of a day because I just don't want to get a gap away like we did this morning.
Sure.
And I don't know which way I'm supposed to evaluate this thing. I'm looking here at an 18-cent profit on 10 contracts is $180. I mean, should I be looking at 20 and 30 of those to make it worth my while, or looking at something like the SPYs to trade higher, or look at the IWMs would trade higher so you'd have more of a movement and more of a point move? I'm just trying to evaluate this thing that I've been sitting here all day and
so remind me again, which puts are you selling?
I sold the weekly TZA July 34s.
Okay, so you're in the TZA. I was just looking here. So can I just ask you, why do you use the TZA? Are you just trying to get a little bit more bang for your buck?
Exactly.
So
exactly.
If you were to use the TZA 34s, okay, those are, first of all, the at-the-monies. The at-the-monies are going to have right around like a 50 delta.
Right.
You could, if you're really got some good conviction on direction, you could use the IWM and actually use a little bit more of an in-the-money option. I mean, for the most part, if you think about this, selling a put directionally is just a bullish position, okay? Buying an in-the-money call is almost the exact same thing. So for the most part, you're selling a put, you're just trying to do an intraday trade. And the reason I bring you back over to the IWM is the bid-offer spreads are going to be a little bit tighter,
okay.
especially in regards to weekly. So if I pull up like TZA, the TZA spreads, they're not bad. They're not bad, I got to be honest.
They've actually narrowed it. They used to be really wicked. It used to be a 10-cent spread, and it was really tough to get in and out of.
You know what? That was not that long ago, because I remember talking to you, and you were asking me about this, and I'm like, TZA, it's the spread's a little bit wide. This is not bad at all. But you got to remember that selling a put on an intraday level, like I don't really care. You're going to close it by the end of the day. You can either sell a put or you could buy a call. I mean, it's going to be the same animal. I mean, you might like decay in your favor. That's fine. You can also turn around there, so that selling the put is, of course, a bullish position. Buying a slightly in-the-money call is going to give you a little bit more bang for your buck because the delta's higher. But you could also do the same thing by selling a slightly in-the-money put, okay? Selling an in-the-money put is going to get a little bit more bang for your buck, but there's nothing wrong with what you're doing at all. And that TZA is from a contract perspective, because it's got, a 3 times, effect to it, it is giving you more bang for your buck contract-wise, meaning that, you're going to have to trade a hell of a lot more contracts in IWM than you are over here at TZA.
Well, and that's what I'm looking at. I didn't know what other daily investment vehicles you're looking at. I mean, besides the, the futures contracts themselves, the E-minis, but...
the Russells, the /TF, that's a big contract. You ever traded those?
Basically the E-minis is what I've been comfortable with.
The Russell?
I was looking at this. I was looking at the TZA just because the fact that these expire on Friday.
Sure.
And you get the decay. Plus, I like selling the puts because you're getting a credit rather than.
So on an intraday basis, do you really get much decay? Well, yeah, on the weeklies you do. So that's an interesting thing that you bring up. So if I pull up TZA and you look even at the weeklies over here, you don't think too much about decay because obviously you're only holding the day, position intraday, but there is definitely some theta associated with that. The options, the at-the-money options, they're showing about 11 cents of decay. Now, the reality is this, though. The decay only takes place if volatility either stays the same or subsides. If volatility during that trading day goes up, the decay then, of course, could be even against you, even if you're selling premium. And volatility going up actually adds theta back in. But at the same time, I like the idea because you got the wind at your back. But you know what a lot of people like yourself would probably do? You basically are waiting for 15 or 20 minutes, the market opens, then you put the trade on. So the decay is already pumped into there, meaning that the volatility is already up. Then you go ahead and sell it. Just as long as you start to realize that, you'll be much better off.
I've just been looking at the IWM. I just see declining tops all the way since basically the beginning of July. We were at 85. We keep setting lower lows and lower highs, and I just see that trend down. So what I'm just doing is waiting for these gap up openings on the IWM in the morning, and then just selling the TZA pretty much at the bottom of the day. I just was looking for any ideas that you came, or just thought that I'm trying to look for more something, a vehicle that'll give me more than a 10-15 cent scalp intraday, and I guess I ought to look at the IWM for a better bang for the buck.
You know what? For an option, you're going to look at IWM. You're going to stay at TZA. That's if you want to trade options. If you want more bang for your buck because you're good directionally, you need to go to the futures product. And there's no question about this. Trading a futures, and it's /TF on ThinkorSwim is the Russell future. There's no question about this. There's some traders that cannot migrate from trading an option into a futures contract, and the reality is it has nothing to do with decay. It has to do with the pressure of the fact that it's a much bigger contract size. And remember, I'm saying this because what you should do when you're migrating is still trade X number of option contracts and trade like one Russell future. The Russell future is a really big contract. A 1 point move in the Russell on the future itself is $100 profit and loss. And on a wild day, you can see a 30, 40-point move in there, and it's insane. That's a lot of money.
Okay, I'll start watching that and monitoring that, because I basically keep the E-mini up along with the dollar index and along with the the Qs and the NDX. And
yeah, you should definitely watch the Russell. I mean, listen, trading IWM anyway, and that's the Russell future, and it's kind of the leading edge of course, the IWM.
Okay, great. Hey, thanks.
Good talking to you again, Jim.
Okay, bye.
So with that, we're going to jump to another caller. But again, we've got plenty of room for plenty of callers here today. So give us a call, of course, 877-927-6648. I'm just shocked. A couple of callers in the queue right now. Nobody is questioning, how do we trade Apple around earnings? What are you guys? I mean, come on. We're definitely going to talk a little bit about earnings as we go on. But that's all I've heard today, and that's every email that I've gotten today from any client was in regards to Apple. So I was expecting, 10 different callers here just on Apple. Anyway, with that, let me jump to another caller here. We got Joseph in Aurora, Illinois. He's got a question about, looks like ConocoPhillips. You there?
Yes, I am. Hi, Don. I've got a small trade, ConocoPhillips. I've got a put vertical for August.
Yeah.
The 72.5 to 70s.
Yep. You bought them or sold them?
I sold them.
Okay.
I sold them for a 60-cent credit.
Okay, great.
And I was wondering if you could look at that and see, offer any suggestions to how I can make it better.
All right. So just looking at ConocoPhillips, I actually happen to know this underlying fairly well. I've got some big institutional clients that actually carry positions in ConocoPhillips, and they were looking to hedge the position, and so this is a stock I've looked at, in a million different ways. So what you've got on, for those of you guys listening right now, what he's actually got on over here is he's short the 72 puts, long the 70 puts. It's a short put spread for right around a 60 cent credit, and this is a $2.50 wide spread for a 60-cent credit. Of course, the total risk in there is about $190 right now to make about $60. Probability-wise, this is a decent trade. If you actually open up, if you guys that are watching on kind of Tiger TV and the screen show over here, go ahead and open up what's called probability of expiring. You'll see that there's about a 36% probability that we close below 72.5, which basically inversely gives you, it's about, let's just call it a 64% probability we close at or above 72.50 by August expiration, 31 days from now. Really, if I'm looking at this is how I set up trades. I mean, I like to sell out of the money premium. This is absolutely a bullish trade. If we stay above 72.5, you're good to go. Other than that, it's I would utilize some type of a closing window for this, meaning like you can close it when you're profitable, but you can also close it a couple of days before expiration. But if this blows up in your face, there's not a whole lot you're going to be able to do to necessarily fix it. But when you say something like, hey, how do I make this better? No, this is a good trade.
I don't mind owning it at 72.5. So that was the other premise for putting on the trade.
So now, I like the logic, but why did you then buy the 70 puts? So why'd you use a spread? You could have just sold the 72 half puts, collected a buck and change over there, $1.35 or so, and sat with it. So I always ask that question because if ever you're willing to own the stock, you should probably just sell a put instead of a put spread. The put spread, does it limit your risk? Absolutely. But listen, you're willing to own the stock anyway. So that's something I always kind of bring up, and it's always kind of think about it. I like when clients go out and do things like they sell puts to get long stock because, again, selling put doesn't add to the risk. It brings in a premium and actually lowers your entrance cost into the stock position. So you could have gone out and just sold the 72 half puts, sat tight, and said, if I could put the stock, fantastic. If I don't, fantastic.
You always want to have a way out, too.
I agree with that, but, the thing is, if you own the stock, you have tremendous risk. And somebody says, I put a stop order in there, but doesn't really define your risk either. So, again, if you're bullish, you're doing the right thing. You're selling a put spread. You're doing everything right. If you're wanting to own the stock, owning stock, whenever I think about owning stock, I never think about it on a short-term, basis, meaning, a client goes out and they tell me, hey, I want to own stock, and I'm going to put a stop order in, and I'm like, that doesn't make sense to me. And I said, what time frame do you want to own the stock for? They go, 30 to 60 days, a short-term move. I say, then just use options. Just use a vertical spread, just like you did. And, when other people say, I want to own stock, well, how many years do you want to own it for? You got to look at stock is a little bit more of a longer-term vehicle. I don't like the idea of buying stock and just using stop orders out there because the options, circumnavigate the need for those stop orders. It's a better vehicle to trade, and it's not because I'm biased necessarily. I'm an option guy. The bottom line is it's better. I mean, you're defining your risk. If you put a stop order in and the stock dips down, you're out, you're dead, you already lost the money. If you use a vertical spread, though, okay, and the stock trades against you, you're still in the trade. The vertical spread defines your risk and allows you to take the pain. And basically, when I say take the pain, the trade blows up in your face, the thing looks absolutely horrible, and all of a sudden, 3 days later, you're golden because you're profitable. But the vertical spread allowed you to stay in the trade, where if you just bought the stock and put a stop order in there, you blew yourself up and you're out of it. And that's just some of the divergence I like to kind of mention in there. And that kind of leads into selling puts, owning stock versus vertical spreads.
All right. Thank you very much.
Yeah, thank you. Thanks for calling in. So with that, we're going to jump to another caller. And again, you guys can feel free to give us a call and talk to us about really anything option, stock, futures related. And I won't hold back. Of course, the number is 877-927-6648. I'm going to jump to the next caller. Looks like that's Franz in Florida. You there?
Yes, I am. How are you doing, Don?
Did I get your name correct?
Yeah, Franz.
Okay. Sometimes I'm communicating with TFNN over instant messenger, and once in a while they put like a typo in there. It's hysterical. They butchered it.
And your name is Don, right?
Yeah, that is correct.
Yes. So how are you doing?
Good. How's it going down there in Florida?
You and Tom and the crew, Basil, Bud, everybody's doing an excellent job. Steve, you guys continue the good work.
Oh, thank you.
Very, very informative. Anyway, the question I had, in general, as far as the couple callers before, trading the E-minis, that caller can add the euro futures, he can add, the crude, and also probably corn to his watch list.
Sure.
Because those are good trading, commodities.
Oh, absolutely. Absolutely.
Of the futures and options.
Yeah, absolutely. No, I don't disagree at all.
So where do you see corn going?
I have no idea. I don't trade it much.
No, I know, but as far as looking at the chart and looking at the December chart.
So, first of all, I'm not that much of a commodity trader myself.
Okay.
Ultimately, when people talk to me about some of the commodity products, it's a product that it's kind of cyclical. You have to definitely follow it. The one thing I like to talk about when it comes to commodities, the one that I do trade, I definitely trade some oil, and I will once in a while take positions in gold and silver. That's my extent of like commodity trading out there. The one thing, though, I'll tell you about commodities is that basically any strategy now you can use in the equities, the ETFs. You can use it on a corn. You can use it on cattle. So it's, people always ask me, a general question like, hey, where do you think this is going? And, the bottom line is the right strategy doesn't matter. When I say it doesn't matter necessarily where anybody that you listen to out there in the industry, it doesn't matter what they think directionally. Because the bottom line is we've got decent volatility right now. We're going to move in both directions. It's whether the strategy you're selecting is the right one. And I'll make an argument, and you're going to see this more and more in the future of trading in general, that it doesn't have to do with market direction. You don't have to be right directionally anymore to make money in this business. It's more about the risk-defined strategy that you utilize, and if you get some decent volatility, you'll be profitable in one direction or the other. It doesn't matter as much as it did in the past. The reason is in the past, you had to be right directionally to make money, and the reason is you had to give up so much edge in the bid-offer spread that it forced you to have to be right. Now, if you look at products today, like a corn, and right up the alley of what I'm talking about, the corn, the cattle, oil, there is no edge given up getting into the trade. The bid-offer spreads are that tight that we now have a fair and two-sided market. So for the most part, you can put on a trade just like a professional, and you can actually sit with that trade and allow the trade to mature. Okay, and the probability of you being right or wrong at some time between now, for instance, and an expiration cycle is almost 100%. If you have the right strategy, basically, it's almost 100% chance that at some point between now and expiration, the trade is profitable, and it's ultimately now establishing some of those strategies more effectively. And, I wish I could give you, kind of my take on corn. Once in a while, I've got, pretty good directional feels on certain products out there, but to be honest, I don't look at corn at all. I don't even have it up on my quote list over here. And it's not that it's not a great product. It actually is trading right now, and meaning that there's definitely some liquidity out there. It's just not, within, I guess, my wheelhouse of what I look at on a day-to-day basis over there.
Okay, all right. That's understandable. Anyway, thank you very much. And anyway, the strategy I like doing with the futures or the commodities is doing, shorter call and a put, and go long the futures, 2 different months. I go long and short the futures also, 2 different months. And now what I'm looking for is a reversal point in whichever leg on the futures that I'm long. I'm looking for a reversal so I can let one of the leg off.
Sure.
And take the retracement.
Right. You're just lifting legs at different times, and that's that's strategy.
And while I'm letting the options do their things, either they're gonna expire in the money or out of the money or at the money.
Sure. Yeah. Absolutely. No problem with that whatsoever. So here I'm happy. I pulled up corn right now. Man, this is a wild market. And,
I'm telling you, it moves.
This is the exact thing that I'm trying to talk about to people is that if you look at like the corn futures right now, and you were looking at a chart, and I happen to pull up like a 9-month chart. You look at this, you got the right strategy in here. You're not going to be wrong because this thing has gone both ways. I mean, it rallied.
Yeah, both ways, up and down. There's volatility in there.
Yeah, definitely, definitely. No, I appreciate the call.
Yeah, thank you very much.
All right, thanks for calling.
Bye-bye.
All right, so with that, we're going to jump to another caller. But if you guys are thinking about calling in, and I'm listening, of course, to a bunch of different callers, a bunch of different products here. I'm also happy to be reading right now in the chat room, and I'm going to answer a couple of questions here in the Tiger Den. But I think you guys should give us a call, 877-927-6648. Let me jump to another caller. It's Kevin in New Jersey. got a question about an iron condor. Are you there, Kevin?
Yes, I am. You hear me, Don?
Yeah. Sorry to keep you waiting over there. I believe we spoke last week, was it?
Yes, we have.
Excellent.
Your first Apple question, I guess, today.
Awesome. I was literally looking it up before, so I typically don't trade Apple only because this is for some reason a stock that I just hate the stock. I love every Apple product. Like my house is filled with Apple products, but I want to get short this stock all the time. That's why I don't trade it because I'm really torn on Apple. But go ahead.
I'm looking at an iron condor. The put would be 355, 350, and the call would be 395, 400.
Okay, are you in weeklies or are you in August?
This is for the weekly.
Okay, so let's hang on. Let me open up a couple of more strikes because I'm actually going to pull this one up. 355, 350.
Yeah, 355, 350.
Okay,
and 395, 400 because the MMM is 1823.
Oh, that's exactly what I was going to bring up. All right.
Right, and you got $1.98 and $1.98.
You're ruining it for me. So for those of you listening here that have no idea what he just said, the MMM is basically $18. What that basically means is a market maker move. Right now, what the market maker move is pricing in, and I'll try to give an explanation kind of for everybody in here right now, Kevin, and we'll kind of look at your trade then in just a second. The market maker move is an indication, okay, of basically it's the at-the-money straddle. What a market maker move means, it's a one-day, one standard deviation move. The market maker move right now is indicating an $18 move up or down in Apple when the earnings come out. That market maker move is based on current implied volatility in the options. All right, but the implied volatility in the options is critical. So if you're listening right now and you're like, I'm a stock guy, I don't look at that implied volatility crap. The reality is the implied volatility is indicating how far the stock is going to move right after the earnings come out. And that market maker move, when I say it's a one standard deviation, it means it has about a 68% probability of falling in that range. Again, the range is up $18, down $18. So what Kevin has actually done is he's constructed what's called an iron condor. It's a net neutral trade. He's selling the 395 calls, okay, and he's selling for the most part 355 puts, and then he's buying the outside hedge, the 400 calls, and he's buying the 350 calls. The whole trade right now is basically a $2 credit. The risk in the trade, well, it's a $5 wide iron. You got $3 of risk on this particular trade. What's neat about this one is he's basically, you're rolling the dice right now, Kevin, on this one. All on the earnings. Yeah.
Is that too far? Is that too far out? Is that far enough out, or because this could take off in any direction?
So I said the same thing about Google, and I think it was last week that I was talking about Google before its earnings came out. And I did a bunch of different chats last week, and I can't remember exactly what I did on this particular show. But Google to me was surprising because Google's market maker move was at $25 and change. It was almost $26. And it was the lowest market maker move that we had seen in 2.5 years. I mean, we haven't even had this feature market maker move in the software for 2.5 years, but we always look at the market maker move. How do we look at the market maker move? We take the at-the-money straddle and just add it up. The at-the-money straddle right now, the 375 straddle on the weekly options are indicating about a $20 move. Market maker move is showing just a little bit lower. But that was the lowest one that we had seen in a long time at $25, and obviously Google absolutely, tore through that.
Blew it away. Right.
But I feel the same way a little bit in Apple. I really do. Like, I feel the market maker move in Apple at $18, it might not be big enough. And
I know. There's a guy that comes on. There's a guy that comes on TV at night that shouts a lot, and he thinks it's going to go over 400 apparently. So
I like looking at the other side of it, man. If you look at the chart on this thing, I mean, the one thing is the markets are going to make up their mind before you have anything that you're going to do. So for the most part, when I say markets have made up their mind, the news on Apple can be absolutely spectacular. This thing could sell off huge. I've always heard from people. I've heard people always say this for years and years. They always said, "Damn, if I just had the news the day before, I could own an island." I totally disagree with that statement, and the reason I disagree with it is, there have been times in my trading career where you knew something was going to happen. Unequivocally, you absolutely knew it was going to happen, and you still didn't pick the market direction the right way. And one of the things I remember, and I'll kind of relate this back to Apple here in a second, but one of the things I remember is there was a monster hurricane out in the Gulf, and it was bearing down, and they said the projection window is looking like it's going to hit New Orleans. And at the time, it was like a Category 3 hurricane. And they said, but this is going to be, pretty drastic. So immediately, as a trader, you're looking at like, oh, man, what can I actually do a little short-term profit off here? This big hurricane is going to hit the Gulf states. What can we do? And immediately a bunch of guys were drawn to Home Depot. And as I'm looking at like Home Depot, I'm thinking the exact same thing everybody else in the street is thinking about. Home Depot was selling off massively. And I'm like, why is Home Depot selling off if a hurricane's going to hit the Gulf? And it's because they had just literally, at the time, upgraded it to a Category 5. And Home Depot already saw the move up, okay, prior to the upgrade to a Category 5. At Category 5, they're already priced in the fact that the cities are decimated. And it was interesting because we're talking days before the hurricane actually hit. They were already pricing in the fact that the city was going to be decimated and that nobody was going to buy anything at Home Depot. By the way, that was extremely accurate trade. And I kind of feel the same way a little bit when I look at something like Apple is, this has kind of been priced in. I mean, could there be upside?
It was 315. 3 weeks ago? 4 weeks ago? It was 315.
This is
now, and the high today was 378. So
yeah, I mean, from a probability perspective, you just don't see moves like this to the upside. I am more inclined, if it's my own trading here and with my own capital, I'm more inclined to actually be bearish on this thing. Please, if you guys are listening right now, don't listen. But I'm more inclined to be bearish on this because it doesn't matter what they say. There's a lot of traders out there that are like, the hell with it. It's just something cannot go up this far or this fast. They could blow away the street. And if the market make up its mind, they may still sell it. And I think it's
would you extend your put side on this, or would you think that that is sufficient?
Your iron condor is ideal. If you set up the iron condor, I mean, the reality is if this thing's going to sell off, it's going to blow through those put strikes, I think, pretty markedly. But, yeah, no, your iron condor is ideal. If you think we're going to stay within that market maker move, this is the ideal iron condor. I wouldn't build it any better. But that's, around earnings, I hedge my bets whenever I talk about, like, earnings because if, sometimes I get a really good feel I would do an iron condor around an earnings announcement, no problem. But you got to realize earnings are a shot. It's not like what you want to create your core lot.
Did you put anything else on besides this for some kind of a hedge if you thought it was going to be negative and go down?
I would actually buy the 380, 370. I wouldn't even do the iron condor. If it's me right now and I'm putting this trade on, I would buy the 380, 370 put vertical. It's an in-the-money put vertical. But if you look at this vertical, it's a $10 wide vertical. You're buying basically for $5 and change right now. It's almost a $5 trade. And it's just risking $5 to be able to make $5. If you're right directionally, you're going to hit it out of the ballpark. If you're wrong directionally, you're going to lose $5. It's right. One contract is $500. Around earnings, it's a tough one. I mean, there's a lot of stocks that I would definitely sell an iron condor coming into the earnings, just like you're doing. Apple might not.
Well, this is going to be interesting. All right, thank you, Don. I appreciate the info once again.
Call next week. Call next week if you want to hear about the trade for sure.
Okay. All right. Thank you. All right.
Thanks a lot. Thanks for calling in. All right. So that's going to be an interesting one there for sure. An iron condor versus directional trade. And I really do believe the market prices things in. Before it's made up its mind, before any of the earnings already come out, anything like that. Information is just disseminated literally at light speed over here. And Apple, let's call this, Apple is very fully valued here at the 378 strike, or 378 price there, and we're right now at 375. So I'm going to guess that by the close of today, we'll probably be hovering still right around 375. But believe me, we'll all be watching the estimates come out on Apple thereafter. The other thing you can do is if you don't like trading Apple directly, you can also, of course, use any of the NASDAQ products, the Qs, the NASDAQ futures. I mean, that's something that has got to be realized. Apple obviously has a heavy weighting into the NASDAQ, and Apple is actually going to drive order flow into the NASDAQ and into the NASDAQ futures. So always keep that in mind. Anyway, with that, I'm reading some of the comments right now in the chat room, too. You guys are hysterical, so keep firing them in. Yeah, we don't have a lot of callers right now, so you guys should give us a call, 877-927-6648, because we've got, another like 15 minutes, and without callers, it's a lonely 15 minutes. All right, so let's actually talk a little bit about a couple of products I've covered in the last few weeks. You know, last week I had so many callers, I didn't even get to discuss all the different trades. But and I'm also reading through the chat room because there was a couple of questions. So let me reference a couple of the questions. One of the first ones that I want to reference over here is how to look up earnings on ThinkorSwim. For those of you that are on the screen show, all you have to do is go to the Market Watch, and we now have a calendar under Market Watch. And what you can do is literally just check off earnings. So all of your earnings announcements, every underlying that's coming out with earnings, you can kind of scroll up and scroll down and look through all the different earnings, what's out, what's coming out. If they have come out, it'll actually give you the earnings estimate out there. So there's just a phenomenal amount of information now provided within our new calendar within ThinkorSwim. The other thing that you can do is on the left sidebar of ThinkorSwim, we've actually got a little gadget. It's called Use the News, and you can create different categories. And one of the categories you can actually create on Use the News is specifically you can create a watch list right around earnings, which will literally give you a watch list of all the underlyings that have just had earnings or about to go through earnings. So kind of keep that in mind as well. It is available to you. All right, let's jump to another couple of questions on here. So feel free to, again, to kind of shoot them into the chat room. I am reading. I also highly recommend you guys give us a call because, well, you know, it's call-in show, 877-927-6648. So again, kind of what's on the menu here a little bit today is a lot of these earnings. And looking here just the last couple of minutes since we started talking, the NASDAQ futures are literally at their high of the day. NASDAQ futures now are up 49.25. So it's just absolutely exploding to the upside. You know, when you see markets rallying like this, there is one thing that, you know, kind of stands out a little bit here. And this is actually kind of an odd thing here. The markets rallying typically see an adverse move in bonds. Bonds are kind of turning around. You'll see TLT right now is actually up with the market up. Well, typically in a cyclical marketplace, and this is something to keep your eye on because you will not see this all the time, but you know, in a cyclical marketplace, typically what you see is when the market's up, bonds literally sell off, meaning that cash comes out of the bond market into, of course, the equity market. Here today, we're actually seeing futures up, NASDAQ futures up huge, S&P futures up 20, and of course, we're seeing the bonds, you know, up. Again, I sit here and I question this because that is a guarded stance, meaning that there is, you know, fear, obviously. Interest rates are a little bit lower over here. There's something obviously going on underlying with this. Very, very fast move, though. Since we've started talking here, this, you know, the TBT was only down about 30 cents. Now it's down about 80 cents. It's a fast-moving bond market. With that, I'm going to jump to another caller here real quick. We'll jump back to some trades here. And, of course, you guys can give us a call, 877-927-6648. Plenty of time to take a couple of callers. I'm going to jump to Mike in San Diego. Just got a general question about option trades. Are you there, Mike? Are you with us, Mike?
Yes. Hello, Don?
There you are.
Hello?
Yeah, I'm here. How you doing?
Just fine. I just calling to ask you a general question about the probability of an option trade.
Mm-hmm.
I understand that that the probability, let's say for a credit spread, would be the amount that you get for the credit minus the spread width, but I'm not sure exactly how to manipulate that formula.
All right, so I'll give you a quick example over here in the spiders. A couple of different ways to look at probability. First of all, the spiders are trading right now at 132 and change. I'm going to open up the August options. They've got 31 days to go to expiration. And let's do an out-of-the-money call spread, meaning I'm selling a call spread. I'll use the 134, for instance, 135 spread. I'll just do a $1 wide spread. I'll just go down to sell vertical here. I'm selling the 134 calls, buying the 135 calls. This particular spread, I'm going to lock the price, is at a 45-cent credit. All right, so how much risk is in the trade? Well, it's a $1 wide spread for 45-cent credit. That means the definitive out-of-pocket risk is 55 cents. If you take the definitive out-of-pocket risk, which is 55 cents, and you divide it by the width of the spread is $1, it gives you a rough probability of success. And that is 55 cents divided by $1 is about 55% probability of making 1 penny or more on the particular trade. And that's how you kind of ballpark it in a nutshell. And kind of show you another one. Now we're going to do the 135.
Excuse me, is that based on a 60 a confidence level of like 1 deviation?
No, that's not how that works. So if I say it has a 55% probability associated with it, that particular trade has a 55% probability of making 1 penny or more. That's based on implied volatility of those particular options at that moment in time. So it's not necessarily set to like 1 standard deviation. You can look at trades based on 1 standard deviation, but ultimately the probability associated with that trade is about 55% based on current market valuation.
Okay. So if I think you or Tom Salsnoff has said that credit spread, in order to make it reasonable, you need to have at least about a third of the spread.
Right.
A third of the third of the spread. Now, I can understand that, but would there be like a maximum, meaning that as you go, if you get something like a 65, like for a $1 spread, if you got like 65 cents, is that meaning that the chances of that happening is very, very low?
Exactly.
And
that's exactly what I'm about to explain to you. Yep.
Okay.
So for the most part, the more credit you receive, the lower the probability of success. There's an inverse relationship there. The reality is this. Some people go, I want a 90% chance of success. Well, that's great, but you're going to collect almost no credit up front. Think about the risk associated with a trade that you're selling, that you have almost no credit. You're going to take a tremendous back-end risk, meaning that if the trade goes against you, it's going to look horrible. We call the sweet spot about anywhere from about 60 to 70% is a very much a sweet spot of the credit you're receiving versus the risk that you're inherently taking. That's a decent probability, and they're all associated, with one another.
Okay, and what you just said, that applies to both puts and calls?
Absolutely. Absolutely. A spread is a spread. Doesn't matter whether it's a call spread, a put spread. It's all the exact same animal.
Okay. Now, changing the subject slightly, on earnings plays, I think last week you mentioned on the air, and I don't remember exactly if it was part of TFNN or one of the TOS things, that you had some slides indicating a guidance to doing a earnings play. Is that right?
Well, no. The slides themselves, it's how we actually derive what's called market maker move, and it's how we derive what a stock's going to move. But for the most part, it's all on ThinkorSwim. So there's nothing that I have got that isn't already on the platform. But it's the math behind some of it. There are engineer math geeks that call me quite frequently.
Well, it turns out I'm an engineer.
Oh,
so if you have math that's behind that, I would appreciate if you can offer it. I mean, I would appreciate it emailed to me. Can I email you?
Sure. Shoot me an email. It's dkaufman at ThinkorSwim.com. It's D-K-A-U, F as in Frank, M-A-N, at ThinkorSwim.com, and I'll shoot you over. I got a little slideshow, and it's basically a 1 standard deviation move kind of slideshow. It just shows you how we take things like probability and break it down. It also shows you, for the most part, it's the same formula as almost the market maker move. Implied volatility can be used for probability of expiring. Implied volatility can be utilized for market maker move. Implied volatility can be utilized and go on and on and on from there for probability of touching. And it's all off of very similar formulas about, it's basically dividing the number of days. Okay, it's the square root, for the most part, of number of trading days left in an expiration cycle, okay, divided by the square root of 365. So you can take the implied volatility times the square root, for instance, of 31, which is the number of days remaining to August expiration, divided by the square root of 365. It's great to understand that there's some math a little bit behind it. If you're an engineer, fantastic. The reality, does it really help you in your trading? Probably not. I mean, when I first got involved in this business, my specialty was kind of option modeling. It's what I was into. I was a science geek. I was actually, studied molecular genetics in college. I'm using that every day, but the reality is the math, I thought it would make me, give me, a leg up in this business. It didn't. If anything, it made me be able to talk to engineers a little bit more effectively, though, now. But, yeah, I'll be happy to send that over to you. Shoot me an email.
Okay, I will. I'll do it this afternoon. Now,
Excellent.
I guess the subject will be just expected move.
Yeah, it'll take me a day or two. I'm running around a little bit here. I'm going to hop on a plane soon, but I'll get it back to you, no problem. That's exactly what it is. Send me an email to the expected move. I got to jump to one more caller because we're running out of time over here.
Thank you.
So thanks for calling in. And I'm going to jump to one last caller here. It's Mike in St. Paul, Minnesota. You there, Mike?
Hey, Don, how are you?
Good. How's it going?
Good. Hey, I'm not an engineer. I'm a fireman. But anyways, I've been picking your brain for the last couple of weeks on all the different strategies, and this week I'd like to talk about the butterfly.
Sure. I like butterflies. I'm not a huge fan.
Give me the lowdown.
Yeah. Yeah. So, I'm a big fan of the butterfly. I like the idea of the butterfly. The broken wing butterfly, Finner and the SEC got together and they changed how the margin works on a broken wing butterfly, and the margin is not favorable to utilize that particular strategy that much anymore. So keep that in perspective, meaning that they margin you now very differently than they used to on a broken wing butterfly. The butterfly itself is a shot. It's a lottery ticket, and it's got to be viewed that way. It's not like a miracle strategy. You can buy butterflies dirt cheap for one reason. They have a low probability of success associated with them. So if you ever do a broken wing butterfly, all a broken wing butterfly does is it embeds a vertical spread into a butterfly. So it's basically like, hey, I'm selling a $5 wide vertical to finance, for instance, a $2 wide butterfly. And it's fine to do that, but you have to keep in perspective that selling the $5 wide vertical has a lot of risk associated with it, and that's the premise why you're doing the trade. Is I'm doing the trade because I'm directional. I'm selling this particular vertical spread. You're not doing the trade because you want to buy a butterfly. You're doing the butterfly because it's a little bit of a lottery ticket on top of this vertical spread. Does that make sense?
Yes.
And firefighters.
So how would you...
Sorry. I was going to say firefighters are easier to talk to. Like everybody that wears a helmet for a living is a good thing.
We're simple. Keep it simple, stupid. It's basically just a lottery ticket. So how would you set that up? It's like a 1-2-1 or a 2-4-2 or something like that.
Well, you're utilizing spiders. What product?
Yeah, spider. The spy.
In the spiders, I'd make it like you can make like a $2 wide butterfly with an embedded like $3 or $4 wide vertical spread in it. So like right now, if you're kind of directional, I'll use the 134 strike. I'll go buy butterfly. I'll rip the strikes off here in just a second. But in this butterfly, I'm going to do like a 132, 134, and we'll do like a 138. Okay, so what I'm actually doing is buying a $2 wide B-fly, but embedding, okay, it's for the most part a $2 wide. It's actually $4 wide vertical spread, of which you've got about $2 of risk in there. The entire trade, though, is done for about a 23-cent credit. But what has to be realized in this particular trade, the max profit is $223, but that's only if you hit the butterfly square in the nail. You got to hit it right on. Max loss, though, is about $177 because there's a $2 wide vertical spread embedded into that butterfly, and that's just the reality behind it. So be directional, meaning that if you sell you sell that vertical spread, you better be able to take some risk, because if we crack above 136, you got to be bearish on that trade.
Okay. All right, Don, I appreciate it.
Yeah, thanks a lot. I appreciate it.
All right, see you.
I'll see you again soon. All right, so with that, I'm going to kind of wrap up here in just the next couple of minutes. A lot going on in the markets over here, and again, I am watching the TLT and TBT very, very carefully because I'm long the TBT, and it hurts. It hurts when it goes down. I think the last couple of times I've done this TFNN show, this TBT is rallied up, sold off, rallied up, sold off. But every time I do this show, the TBT sells off. For some reason, I like to take pain while I'm on this show. So this is not a good day for Don's trading over here right now. And again, these little moves don't kill me, but for the most part, it is painful to watch this type of a move. So of course, Apple after the bell probably drive a lot of the order flow for tomorrow. Keep your eyes peeled for that, and you can listen to all the media you want. When Apple releases its earnings, okay? The bottom line is this. When Apple releases, all you got to do is pull it up in the ThinkorSwim platform, pull it up in the trade tab, and watch the bid and offers. And you can actually watch exchange level. It's like a version of NASDAQ level 2, see who's bid and who's offered out there. It's always interesting when the earnings come out because you'll see the move, instantaneously after those earnings are out. Markets are literally at highs of the day. ES futures up 18.75. NASDAQ futures up almost 50 on the day. Wow, absolutely on fire. The VIX only down about $1.36. And again, bonds are moving up right now with the market moving up. Very unusual kind of circumstance over there. Could be an indication of something possibly going on in Europe. Again, I'm not watching the news right now. I'm talking to you guys. So something definitely to keep your eyes peeled on over there. And, of course, gold is actually off quite considerably right now. Could also have that's got a link definitively to the bond markets as well. I am actually going to be back, of course, next week for the option hour. But also this week, later in the week on Thursday, I'm going to take over Tom O'Brien's show on this Thursday, so by all means tune in and give us a call. That is always kind of an exciting show to take over for Tom O'Brien. Hopefully I'll do half the job that he does. Anyway, with that, again, thank you for everybody that called in. Have a good week trading over here, and keep your eyes peeled for some of the earnings coming out because it's going to be an exciting week. With that, on behalf of TD Ameritrade, ThinkorSwim by TD Ameritrade, myself, Don Kaufman, thank you guys very much for joining us today for the Option Hour. And, again, see you later this week. Thanks a lot, everybody. Have a great day. Bye-bye.